Welcome to Stifel's Sightlines podcast, focusing each week on a topic or two important to investors. Well, greetings and welcome to the Sightlines podcast. This is Michael O'Keefe, Stifel's Chief Investment Officer. I want to continue our discussion about Outlook 2025 Gravitational Shifts. This is the report we published last week, and it includes a bunch of different articles. You can certainly go to stifelinsights.com and see the full report, a video that we did, a replay of a recent client webinar. But in this episode, basically, I want to dive into the article that actually has the same name. So we do this broad body of work, but the anchor article for this publication is our outlook for the year, right? So it's Outlook 2025 Gravitational Shifts, the article that I want to get into. And so think of it as where we sort of capture what we think for the year. And I do want to comment on that in the context of what happened in 2024. So anyway, let's jump into it. And I hope you find this helpful. So let's start with what happened in 2024 when it comes to inflation, the Fed, and the economy. And the punchline here, of course, is that the Fed ended up cutting rates 1%. We did see inflation cool some, but not back certainly to the Fed's 2% target. So for example, the consumer price index ended up being up 2.9% in 2024. And again, this is against the backdrop of 1% in rate cuts by the Fed through the year. So when it comes to what we think looking forward for inflation and Fed policy, we're seeing basically inflation for 2024 coming in a little lower, but still not back to the Fed's 2% target. We're calling it at about 2.5%. And we expect the Fed to cut rates twice, a quarter point each, roughly in the second half of the year. So much more modest cuts in 2025 than certainly were expected, as if we go back a few months ago, and also, of course, less than what we saw last year. Now let's turn to the economy. So once again, the economy, in this case, outperformed in 2024 compared to what was expected as we started the year. GDP grew at an estimated 2.7% for the year, with a lot of strength in the second half. And so, when you think about that as sort of a foundation, it's almost like momentum as we get towards the end of the year, but then maybe sort of supported further by some optimism that sort of come from the outcome of the election. So a Republican sweep, an incoming administration that's going to roll back some regulations, push to lower taxes, things like a survey of small business leaders basically is already showing optimism about the upcoming administration. All of that's adding up to a positive view that we have on the economy. Maybe not quite as heavy or positive as in 2024, but we're calling for a GDP growth rate of between 1.5% and 2.5%. Now, the long-term consensus view is 2.1%. So we're, in round numbers, that's sort of our midpoint, and we're looking at 1.5 to 2.5 as a range. Now, all of that, sort of serves as a foundation for the equity market. So think of it as, how's the economy doing? Where are interest rates going in terms of Fed cuts? Is inflation cooling down? All that kind of thing. And so anyway, to take a look once again at 2024 as a foundation to build up to our 2025 forecast, the S&P 500, as we've discussed before, I think, was up 25% last year. And so one of the things that happened was an expansion of what's called the price earnings ratio. It's a popular valuation metric. And basically that rose to a level that sits at a 23% premium. That's a 23% premium to its own 10-year average. So think of it as a market being a little bit richly valued. And, that combined with a little bit some underlying assumptions about earnings growth and things like that, we come up with a year-end target for the S&P 500 of 6,200. It's a very round number, kind of industry convention to do that. And that translates to a total return for the year. It would translate to a total return of the year 6.7%. And so that, is a much more modest, it's still a good return, but much more modest compared to what happened in 2024. Now, as is always the case, we do frame up a couple of alternative scenarios, a bull case and a bear case. So of course, the bear case is the negative one. We labeled it roadblocks to growth. And in this case, what we sort of framed up was the idea that, well, you know what, for all the effort that they're going to try to make in DC, we see little progress, we see continued dysfunction. That could lead to a disappointment on the part of consumers and businesses, a slowing of growth, a muting of animal spirits, a muting of and sort of softening of earnings. All of that could lead to a more muted stock market, and in fact, even potentially a negative stock market. So that's the roadblocks to growth scenario. The bull case, positive side scenario, we labeled American exceptionalism. So in this case, basically we see even more deregulation and maybe efficiencies gained in DC than is even reflected in, or are even reflected in our base case. That could drive innovation. It could drive company results, earnings. It could lift animal spirits and inspire the consumer, for example, to continue spending. All of that could drive markets even higher than our base forecast for the year. And so again, I think it's a good discipline to basically think in terms of a base case and then a more negative bear case and a more positive bull case. So we framed that up in the article we entitled Outlook 2025 Gravitational Shifts, which again is a part of the broader report with the same name. So once again, I would invite you to go to stiefelinsights.com, and right at the top, you're going to see links to the full report, the video, replay of our client webinar. So we always want to say thanks for listening to this episode, and we will catch you on the next one. Thanks again for listening to Stiefel's Sightlines. Be sure to subscribe wherever you're listening to automatically receive each week's podcast in your feed.